Payday. Whether it's a salary, weekend shift pay, or tutoring cash, drops into your account and suddenly everything feels possible. Within 48 hours, the balance shrinks. Auto drafts, small tap-to-pay treats, and forgotten subscriptions drain it fast. If you're a student navigating tuition or a working professional juggling rent and bills, this video is your reset point. You'll learn 6 day-one actions that turn each deposit into steady financial progress instead of a brief surge that vanishes. Stick around to lock in a system that keeps your money working long after payday. Step 1. Calculate your expenses. First, determine your essential living costs. Open a note or spreadsheet and title it Core Monthly Expenses. List every category that must be paid to keep your household running: rent or mortgage, basic groceries, electricity, water, transportation, phone plan, insurance premiums, and minimum required loan payments. Next, review the last 3 months of bank statements and record the actual amounts spent in each category to create an accurate average. Add a 10% contingency. This buffer covers unavoidable, unexpected needs such as a medical copay, a modest car repair, or a school fee. Implementation checklist. Download the most recent 3 months of statements and compute category averages. Tag each expense, need, or discretionary to see where adjustments are possible. Set a quarterly reminder to update the spreadsheet for price changes or new bills. Optional color code: one color for fixed costs, another for variables, and a third for savings targets. Result: you now have a precise monthly figure that must be reserved before any non-essential spending occurs. Knowing this baseline allows every subsequent step to be built on solid numbers rather than estimates. If this practical approach already makes sense to you, consider hitting subscribe, only if content like this truly helps you manage your money better. Step 2. Build a 1-month crash pad. Think of this reserve as your financial airbag. Quiet, hidden, but life-saving when the unexpected hits. Your goal is 1 full month of essential expenses, the exact figure you calculated in Step 1. Open a high-yield savings account that allows custom sub-accounts and nickname the new bucket Crash Pad. If you can fund it in one transfer, great. If not, automate smaller deposits every payday until you reach the target. Use a payday plus 1 rule, so the money exits checking before streaming services or late-night scroll purchases get a chance. A solid account offers same-day transfers, 0 monthly fees, and FDIC insurance for peace of mind. Treat the crash pad as untouchable unless you face a real emergency: medical copay, urgent car repair, or last-minute travel for family. A weekend sneaker sale? Nice try. That's future you talking. Most people feel calmer with this cushion because it buys time to think instead of panic. Review the balance once a year to keep pace with any rise in living costs. This simple buffer prevents small setbacks from snowballing into high-interest credit card debt and keeps your long-term plan on track, like caffeine for your financial peace of mind. Step 3. Pay off high-interest debt. Interest charges above 7% are silent budget leaks. Anything at 20% is practically setting your paycheck on fire. Here's the plan. 1. Inventory everything. Open a simple spreadsheet, list every debt, and sort by APR from highest to lowest. Include credit cards, store cards, personal loans, everything. 2. Minimums on all, extra on 1. Keep paying minimums across the board to protect your credit score, but direct every spare dollar toward the highest rate balance. Finance nerds call this the debt avalanche. 3. Run the numbers. A $2,000 balance at 19.9% eats roughly $33 in interest every month, enough for a modest grocery run or 5 streaming subscriptions you actually want. 4. Lower the APR wherever possible. Call the issuer and ask for a reduction. Success rates hover around 50% if you have on-time history. If they say no, price check a 0% balance transfer card or a small personal loan refinance. 5. Attack with windfalls. Tax refund? Birthday envelope from grandma? Marketplace side hustle income? Route it straight to the target balance. One extra payment of $300 can shave months off the payoff timeline. Does this feel aggressive? Good. High-interest debt compounds against you daily. An aggressive plan simply returns the favor. Quick recap actions. Review APRs, choose the top target, automate an extra payment today, and set a calendar reminder to renegotiate the rate every 6 months. Step 4. Maximize workplace pension. Earning a paycheck is great, but doubling part of it is even better. If your employer offers a retirement match, whether it's a 401k, 403b, simple IRA, or workplace pension, take it. Ignoring that match is like refusing a raise that's already sitting on your desk. Example, you earn $4,000 this month and the company matches 5%. You contribute $200. Payroll magic drops in another $200. That's an instant 100% return before the stock market even opens. Keep that up for a year, and you've banked $2,400 of free money, roughly the cost of a new laptop or a semester's textbooks, courtesy of your boss. Action checklist. Log into your benefits portal today and set your contribution to at least the full match percentage. Choose a broad, low-fee index fund or an age-appropriate target date fund so the cash is diversified automatically. Each time you receive a raise or cost of living adjustment, bump your contribution up 1% before the extra cash reaches your spending account. Future you won't miss dollars never seen. Side note for part-timers and interns, if a simple or Roth plan with a match is on the table, grab it. The math works the same. Step 5. 6-month emergency fund. Your 1-month crash pad covered potholes. Now it's time to construct a 6-month fortress, a reserve strong enough to handle layoffs, medical surprises, or a sudden tuition spike. Why 6 months? Data from career sites shows job hunts typically last 3 to 5 months, and most short-term disabilities clear within a half year. 1 extra month is breathing room. Target amount. Multiply the core expenses number from step 1 by 6. That is your fortress wall. Where to store it? Park the cash in a high-yield savings or money market account that is FDIC insured, allows instant withdrawals, and currently pays around 4 to 5%. Avoid locking it in certificates or speculative assets. Liquidity is part of the safety feature. Funding plan. Direct every bonus, tax refund, freelance check, or cash gift straight into this account until you hit the goal. Automate a small weekly transfer so progress continues even in months without windfalls. Maintenance. Review the balance once a year and adjust for inflation or lifestyle changes. Label the account "Break Glass Only." It sounds dramatic, but that name discourages casual dips for impulse vacations. Step 6. Auto-invest the rest. Now, let your money work quietly in the background while you focus on classes, career, or family. Core portfolio. Approximately 90%. Schedule an automatic transfer for Payday +1 into a low-cost brokerage. Allocate the funds to 2 broad index ETFs, one that tracks the total U.S. market and one that tracks international developed and emerging markets. Using a fixed dollar amount each pay period is called dollar cost averaging. It removes the pressure of timing the market and ensures consistent accumulation of shares regardless of short-term price swings. Satellite sleeve approximately 10%. Once the core is funded, direct a small portion towards specialized themes, such as technology, renewable energy, or real estate investment trusts. If those align with your risk tolerance and long-term goals, treat this allocation as optional growth, not a replacement for the diversified core. Tax efficiency. Whenever possible, use tax-advantaged accounts, Roth IRA, 401k, ISA, or equivalent, so dividends and capital gains compound without immediate tax drag. Annual tune-up. Set a calendar reminder to review asset weights once a year. If one area has grown beyond its target percentage, rebalance by redirecting new contributions or selling a portion of the overweight fund. Keep total expense ratios below 0.20%. Saving even 1% in fees over decades can translate into tens of thousands of additional retirement dollars. Recap. Let's consolidate the plan so you can move from theory to action. Step 1. Calculate your core living expenses. Step 2. Place 1 month of those costs into a separate crash pad account. Step 3. Pay down any debt with an interest rate above 7%, starting with the highest APR. Step 4, contribute at least enough to capture your full workplace pension or 401k match. Step 5, grow the crash pad into a 6-month emergency reserve for sustained security. Step 6, automate broad market investing and rebalance once per year. Together, these steps create a cycle that protects essentials, removes costly liabilities, builds resilience, and channels surplus into long-term growth. Choose the next step you'll implement today and set a calendar reminder to review progress in 30 days. Tell us in the comments which step you're tackling first. Your decision may encourage someone else to begin. If this framework clarified your financial direction, please like the video so it reaches others who need it. Subscribe if ongoing practical guidance will help you stay on course. This video is for educational purposes only and isn't financial advice. Always do your own research or consult a licensed professional before making money decisions.